Okay, hello and welcome to this Module 5 of the Price Ladder course. And this is where it starts getting interesting, guys. We're going to be going through maneuvering around algorithms on the price ladder. Um, and so to do this, I'm going to have to go through what algorithms are. Going to look at the various types of algorithms, what kind of, you know, what kind of animals are there in this market that we are unaware of? And when I say animals, I mean literally. They've actually called some of these algorithms, given them animal names. And so in this part, this segment of this module 5, we're going to be going through what are algos. So algorithms are also called algos in short. And what types of algos exist in the market? So the sole purpose of what we're going to be discussing now is basically just to give you guys a background on what there is actually in the market right now from the perspective of the algorithms that we can find. And there's various algorithms we can find. And the reason why I'm going to go through this in quite a lot of depth is because algorithms actually make up a large majority of the volume in the market. I think some stats read up to about 70%, 75% of the market volume is done by algorithms. So it's so crucial that you understand your opponent, because in this market, obviously, it's everyone's a competitor to someone else. And in a zero-sum game, in fact, with costs and transaction costs um, and desk fees or whatever you have, um, it's actually a negative sum game. So understanding your opponent in depth is super crucial, because that way you can see how they're executing, what strategies they're putting into place, and why. So first and foremost, I want to draw a spectrum from you guys, because in one way or another, we're all algorithmic traders. Every good trader is an algorithmic trader. If you're not an algorithmic trader, you're a gambler. So what do I mean by that? Um, let's just make this, so we'll call it the algorithmic spectrum. So if we drew this algorithmic spectrum, and we drew it something like this, on this side of the spectrum, we'd have our fully discretionary, and at this side of the spectrum, we'd have fully automated. Now, just because you're a discretionary trader, you might say to yourself, wait a second, I'm not an algorithm. And then there's a lot of negative connotations for people that do trade discretionary. They have a very negative connotation towards algos in general, but they don't realize themselves that their decision-making process is algorithmic. So, from a pure statement, what an algorithm is, it's just a decision-making process. You can just basically say anything that uses the statement very simply: if this, then do this. So how do I put that into context? If um, the market breaks the high, then buy the high. If the market fails to close above the high and closes back inside, then sell. So any of these statements, a good trader is going to have an algorithmic process behind his trading strategy, no matter what. If you don't have one, you're a gambler, because you're just putting on a trade without understanding why. So let's just understand first and foremost that we're all algorithmic traders. Then you get, obviously, the other side is the fully all automated guys. You might have some guys, in the middle of the spectrum, um, that have a system, but execute they execute discretionary. So it's not fully automated. When the system actually gives them a signal, they get into a position. So, and along this, you're going to have various different types of traders within that spectrum. But if we just purely go through if we just purely go through now the different types of algorithms in the market, and we'll name a few, and then try and get a little bit more in depth in each one. I don't want to go too crazy on this, but I just want to try and at least give you guys a full spectrum of what we have in the market at the minute. So from the very simplistic side, you've got your basic technical system traders. So they'll do stuff like pairs trading, and when I say pairs trading, they'll trade one security against another security when they see certain imbalances. But you know, it doesn't have to necessarily be on a very short time frame. It could be on a longer time frame correlation when, let's say the Bund versus the 10-year yield spread goes at a multi-year high. They'll take that position, trying to revert that back to the mean. It's mostly a mean reversion type trading strategy, and you'll have just this is just one example. There's loads of examples. There's examples of trading strategies, very simplistic moving average crosses. This is probably the most simplistic one. You'll have trend following. So there's a bunch of them. This one, like we said, was mean reversion. And there's a lot of different systems that you can actually put into play. That's probably one of the most simplistic ones that you can actually see in the market. Then we get a little bit more advanced, and we start looking at the actual institutional trading algorithms. So what do I mean by institutional trading algorithms? So we'll have certain algorithms that are called trade execution algos. And these algos, for the most part, are liquidity seeking. So by nature, these are liquidity seeking algorithms. And they're designed to minimize price impact of executing trades of large volume. That's basically what they're there to do. And you usually find these trade execution algos at large investment banks. And when they're trading on the client's behalf, they'll put on the trades using these algorithms. So usually found at investment banks. That's usually where we'll find these trade execution algos. And some examples of these, there's a ton. I mean, each bank has their own. They name them differently. I've taken some examples that Credit Suisse use. Credit Suisse is a very big Swiss investment bank, and they're notably quite well known for their advanced execution system. I think that's what it's called. It's AES at Credit Suisse, and they have a ton of different algorithms. So the most common one that most banks use is called the VWAP. So the VWAP, it stands for volume weighted average price. And basically, it'll accumulate the volume at each price, and it'll weight according to each price a figure that basically moves. It's basically like a moving average according to the volume on the day at each price. So basically, where the majority of the volume is taking place, if a bank trader has a mandate to trade around the volume weighted average price, every time it moves towards the VWAP, will, let's say, buy 1,000 contracts or 2,000 contracts. So that performance benchmark is going to be for that execution trader. So at the end of the day, if he's outperformed the VWAP by 2-3 basis points, he's done his job well. If he's underperformed the VWAP, then he's not done his job very well, or the algorithm per se hasn't done its job very well. So that's one type of algorithm. Then you have a very similar one called the TWAP, which is basically the same thing. It's just the time weighted average price as above, as you can see above, basically. So the time weighted average price, and that's basically the same thing, just based on a time, and they'll split up the orders according to the time in the market. that's just one example. These are two of the probably the most popular execution algorithms that are used at investment banks. And I'm not going to go through this in much depth. You can look them up online. That's not what I'm here to teach you guys. But there's loads of them. If you look at, there's even one called, like I was saying before, they've given it an animal name called the gorilla. And the gorilla basically just slices up big orders into small, undetectable sizes and works the book. Um, so you've got the gorilla algo. You've got even something called the sniper, and that just basically never displays a bid or offer and just sniffs out hidden liquidity in the market. You've also got something called a sniffer. That uh, basically just sniffs out liquidity by putting bait. So it puts bait into the market, an order as a bait, and if it gets hit relatively quickly, it starts sniffing out liquidity so it can try and execute. So all these strategies are basically used to minimize the impact of them on the market. We talked about this before in some of the previous modules. If you've got a large order to go through the market, you don't want to have a large impact on the market. You want to try and get the best execution as possible. That's why a lot of the times you see absorption, a lot of the times you see iceberging, you see these order types that come into the market when it sniffs out liquidity. So these are some of the things that you'll find from a trade execution perspective. Now, the last element that I want to go through is where we start getting a little bit into the dark arts. This is the dark side of algorithmic trading, or at least what a lot of people think is the dark side of algorithmic trading, and this is really where the majority of the money is made, and this is a speed game. So basically this area, I'm sure all of you guys have heard of this before, is high frequency trading. And these algorithms work at tremendously high speeds. I mean, they work on a completely different spectrum to what you even think is possible. So if you just look at the spectrum of how quick someone can execute a trade by hand or by broker, they're working on milliseconds, nanoseconds, just incredibly small time frames. They can execute thousands of orders in a millisecond. So they're very, very quick. This is how you define these high frequency trading algorithms. And there's various different types of them. So you'll have, for example, a very common one, and a lot of these high frequency trading firms are actually proprietary trading firms. They'll trade with their own capital. Very few of them actually trade with client money, but there are some that do. You'll have huge institutions like GetGo. You'll have Citadel, Renaissance. These are huge high-frequency trading firms that trade on a very quick basis. And some of the actual strategies that they use. So one of them is electronic market making. Now, don't be fooled. It's basically like the traditional market making that we used to see in investment banks, but that's no longer there anymore. A lot of the market makers at investment banks are just kind of redundant because their jobs can be done by someone a lot quicker. And this is by nature, like it used to be in the past, is liquidity provision, um, and they basically just make a two-sided market, and they aim to profit from earning a bid and ask spread. That's basically their job. And they can quickly just get in and out of the market by, they get filled on one side, immediately hedge, and they make a quick bid and ask profit that way. So obviously with that speed advantage makes it highly lucrative business. Another form of high frequency trading is statistical arbitrage. Um, you can look this up. It's basically like relative arbitrage. It's kind of like what I explained before in pairs trading. You basically look at correlated prices between securities, and you trade off of these imbalances in the correlation. So you watch how these um, these stocks are trading relative to each other, and then you try and take advantage of the little price discrepancies. If you've seen, if you just take, let's say, let me just draw a quick example. If you've got stock A that trades like this, and then you've got stock B trades like this, something like this, but they're generally, I mean, if you generally plot them, they're generally moving in the same direction. Um, you're usually, as a strategy, you know, uh, selling this one here, and buying this one here, and you're looking obviously for this to move this way and for this to move back this way. And you're just basically looking at the correlation, trying to take that relative arbitrage between the two. And for the most part, this is on a longer term time frame. On a short term time frame, you get these kind of oscillations as well. If the spread between the two quickly goes one way or the other, they try and take a quick few ticks out of that. So that's just one strategy that high frequency traders use. Then we have what's called liquidity detection. And this is an interesting one. Liquidity detection is basically these HFTs, these high frequency traders, high frequency trading programs. They ping small orders to detect larger orders in the market. So they ping small orders, and when they detect a large order, they can trade off of it or trade with it, whatever it may be. They're basically, in this kind of environment, I'd say with the HFTs, they're more predatory than liquidity seeking. So they'll find the liquidity, but they'll try and actually front run the size. So if they find the big orders in the market, they'll try and front run it. So it's kind of like, for example, if you had a ship. Let's just try and draw a ship here. So if you had a ship like this, and it was kind of floating along the water, and then you've got a very large iceberg, whatever, that's our iceberg. And what this ship will do is actually send out, for example, these pings, these little sonar, and then when it detects the large order, it sends the order back. It says, hey, there's a big order here, it's a big iceberg. Let's interact with it. Let's, steer our sails this way again. Move the other way from it. If it's a big order, try and move away from it. Try and buy in front of it or sell in front of it, depending on if it's an offer or a bid. So that's kind of the full spectrum of all the algorithms that we've seen in the market. In the next video, we're going to start looking into a very, very interesting topic of spoofing and layering. I'm not necessarily going to try and put this in any one of the categories, but what I'll try and do is try and define it, and actually understand how to spot it. And we'll take a look at one in the order book that we can see here. It's actually going to be looking at this specific spoofer that we see on this order book on the Bunds. So stay tuned. We're going to be going through that in just a moment.